Welcome, everybody, to another episode of Smart Money Circle. I'm your host, Adam Sarhan. With me today is Colin Carter, Managing Director at Tiedemann Advisors with approximately $20 billion in assets under management. Colin, welcome to the show.
Great. Thank you, Adam. Appreciate you having me.
Thank you. So I always like to begin, Colin, can you give us a little background about your, really how you got started in the business?
Sure. I got started in the business roughly 30 years ago. I came out of grad school from the University of Texas, and I started at Goldman Sachs in 1988 on their fixed income desk, which was known at the time as their liquid capital markets desk. Spent roughly 3 or 4 years there covering institutional clients. And then within Goldman, I switched to the private client side and spent the next 6 years there at Goldman and left in 99 to go to Merrill Lynch. I spent 5 years at Merrill Lynch in their high net worth group. And then in 2003, I joined a college roommate of mine from grad school and was basically, on the ground floor for the creation of a firm called Presidio. And Presidio was a registered investment advisor. And in the early 2000s, it was relatively a new concept to be independent from the big Wall Street firms.
Right.
And fast forwarding to 2016, Presidio merged with Tiedemann Advisors in September of 2016, and that brings me to where I am today.
Nice, very nice. And can you tell us a little about your investment strategy?
Sure. I'm an asset allocator, Adam, at the end of the day, not a stock picker. Our whole strategy at Tiedemann is really managing risk.
Okay.
And whether we're managing volatility of the equity market or we're managing interest rate risk or credit risk in the bond markets or other types of risks, our role is to make sure our clients achieve whatever they're looking to achieve in the capital markets on a risk-adjusted basis. If we get the risk equation right, we believe returns will take care of themselves.
Right.
And what I've seen too many times over the years is investors at the beginning of the process don't know what to expect from the capital markets. And as a result, when times get tough, they tend to bail out at the wrong time.
Right.
So what we try to do is educate folks from beginning to end and every point in between so they can stay the course.
No, I love that. So that's a good segue to my next question. How do you handle risk? And then what are some timeless mistakes you see people make with respect to risk management?
Well, it's not understanding risk, Adam. And in our view, the capital markets long term, if you have a properly constructed portfolio, you don't necessarily have risk. You have volatility issues. And risk we define as buying an asset that goes to zero.
Okay.
If we do our job right, we don't buy assets that go to zero.
Right.
And all we have to deal with are values going up and then occasionally down. And when they go down, define that as volatility and not the loss of capital. And they're two very different ideas that we need to really educate our clients about.
Yeah, can you educate us a little bit about the difference? I've kind of have an understanding of where you're going, but I'd like to hear it from you if possible.
Yeah. Again, buying a risky asset is buying an asset that could go to zero or get permanently impaired, and it doesn't come back in value.
Right.
When we look at the volatility at the portfolio level, what we try to help folks understand is you can accept a decline in market value. The securities, the positions that we own will come back in the course of time. We'll make adjustments in more volatile periods,
Right.
but understanding that prices go up and down is just part of investing. What scares people when prices go down and they don't rebound, that's
Right.
when they get out and they suffer permanent loss of capital.
So help me understand something here. So if you buy, let's say you're interested in buying stocks and you buy Apple, for example, the odds of Apple going to zero are relatively close to zero. So you're saying, okay, let's say you buy it at 100 and it goes down to 50, you're down 50%, but you'd view that as being just a part of the longer term process. And it's just volatility within owning the stock. Because if it goes up to 150, you'd be up 50% from the initial entry. And that's part of it as well. Is that correct?
Right. And in your case is a little bit extreme because you have single stock risk.
Okay.
So we try to diversify that risk away from folks getting too fixated on one position in the portfolio. And you have to look at the portfolio in its entirety. But your example for Apple's can also apply in the sense that if you tell a client up front that sure, Apple can go down 50%, but understand over the long run, over the next 5 or 10 years, it's going to recover and it'll be worth more than $100
Right.
in the future.
Yeah.
So preparing them for the rainy day is really important. Setting expectations up front of what can happen is important.
Understood.
And when we talk to our clients up front, we try to model out to the best of our ability the worst case scenario. So if it does transpire, they're prepared for it. We increase our credibility by having them understand up front this can happen.
Right. No, that makes perfect sense. So as an asset allocator, I'm assuming you're not looking specifically at individual stocks. You're looking at just a better way of allocating. You'd go into sectors and other areas, commodities and currencies and things of that nature, or how would you allocate?
Yeah. And we divide assets up into 3 primary categories.
Mhm.
First are what we call stability assets, which are your high grade corporate bonds, your high grade munis, and cash.
Okay.
Then the second bucket we have is the diversified bucket, which can be non-rated munis, certain credit situations, distressed credit. It includes gold. It can be high yield as well. But in this diversified bucket, it is intended to be assets that are less correlated with interest rates and less correlated with stocks. And the equity bucket or the growth bucket is stocks and private equity.
Got it. Okay. Equity bucket. So there's the stability bucket, diversified bucket, and then the equity bucket.
Growth bucket.
Oh, the growth bucket. Sorry. Okay.
Yes.
Growth bucket. Perfect. And then that would be stocks and PE and private equity.
Yeah.
Got it. Okay, great. So as far as selling discipline, how would you, if the environment changes, let's say whether we go into a recession or we go into a bear market that's protracted for whatever reason, or COVID, like we're in now, or whatever the case may be, do you change the allocations quarterly? Is it annual? Or is it depending on market action? Or how do you change the allocations?
Yeah, good question, Adam. We meet with our clients 4 times a year. We report to them as we would a board. So our changes tend to be more incremental.
Okay.
But fast forwarding to where we are today and how we got to our current allocation, we had been reducing our exposure to the stability bucket gradually over the last 2 years as yields have slid down. And right now with interest rates at or close to an all-time high, we're underweight interest rate sensitive securities. Most of the capital in that bucket has shifted to the diversified bucket, where we're willing to take on more credit risk now and less interest rate risk.
Okay.
So our adjustments tend to be strategic. Making tactical changes in this environment is really difficult. It's not impossible. Right. But a lot of those tactical changes are made at the manager level.
Understood. So you hire other managers. Selection. Understood. Other managers, and then you'd allocate to them, and then they'd take care of the specifics.
Correct.
Understood. So what are some timeless lessons, Colin, you've learned along the way that you'd like to share with the audience with respect to investing or money or anything along those lines?
Yeah, I think in terms with respect to investing, it's helping folks understand what they're trying to achieve day one.
Okay.
And that it's a process, and there are no shortcuts.
Right.
You have to be involved, year in and year out. It is impossible to time the market. And before you set off on, really developing and creating an investment portfolio, make sure you have a roadmap of what you're trying to achieve with your capital over time. Because if you don't, and if you set out down a road, you have no idea where you're going to end up. Yeah. You have no idea how to make adjustments, and you need to understand and have the data to make the right decisions and the appropriate decisions over a long period of time.
Right.
And, nothing's set in stone, but an investment policy statement for individuals is critical, and they can be modified, but you don't modify them in the eye of the storm. When we had this giant sell-off, this historic sell-off in March and April of 2020, right. That's not the time to be making adjustments to your portfolio.
Right.
You make adjustments before you get in those time periods so that you can stay the course and do the, tax loss harvest or do some rebalancing in those periods. But you want to avoid the panic scenario that you read about way too often.
No, that's a great idea. So as far as coming up with a policy for each investor and create a policy or a roadmap for yourself, what are some, I guess, do's and don'ts, if you will, to educate the audience a little bit about things they should do to create a good roadmap or things they shouldn't do?
Well, have a handle on how much you plan to disperse or pull down from your portfolio, right? How much do you need to, maintain your lifestyle, put kids through college, and have an idea of what's going to be demanded of your portfolio. Then once you do that, you're better able to construct a risk framework around that portfolio so that, your advisor could help model something to suggest that if your portfolio drew down 10%, is that going to change your outlook, your lifestyle? Is it going to impact you emotionally where you're going to abandon the strategy? If the answer is no, go down and test. Are you okay if the portfolio goes down 15%?
Right.
The answer is no, you can take on more long-term volatility risk. And again, we don't think it's a risky proposition to have more volatility in the portfolio, but you need to understand what it does and ultimately what it buys you in terms of additional return long-term.
Understood. No, that's really good advice. So what are some timeless mistakes you see people make, and how do you recommend they avoid them?
Well, number one, again, we've already hit on a few times. It's just the panic, right?
Yep.
Abandoning the portfolio. And I look at a publicly traded portfolio where you have the liquidity, you have the ability to get out within, let's say 2 or 3 days, right?
Yeah.
They're liquid securities. You can trade stocks and bonds daily. You can be out probably by the end of the week. Well, that's a luxury that people, I think, abuse. I look at a portfolio like, in a way, a private company. If you built a private company,
right,
you're not going to sell it at the bottom of the market because you know the value and the resiliency of that portfolio, of your company long term.
right.
Look at your publicly traded portfolio the same way. Don't sell it on a whim. You wouldn't sell your house on a whim.
Right.
You know what it's worth.
Right.
And you're not going to sell at the bottom of the market if you can avoid it.
Right.
Same thing with a public portfolio. Don't let the liquidity become your enemy.
So basically don't panic when the market goes down, expect it.
Absolutely.
Instead of panicking, expect the volatility like you said earlier. So no, that's fantastic. If you go back to when you were 20 or 30, what's some advice that you give yourself, 20, 30 years ago, 40 years ago, just for people getting started in the business, or they've been around for a while, but they haven't, they hit a wall, they haven't been able to, get really successful at investing, what have you? What would be some good advice you could tell yourself?
Yeah, Adam, I think at the end of the day, we're in a relationship business.
Okay.
And you're going to get as much out of it as you're willing to put in on behalf of your clients. And I think the durability of relationships with clients is driven by communication. I don't have to be the world's greatest asset allocator. I don't need to be the world's greatest stock picker, but you need to be there, each and every turn in the road for your clients. And it's just time on task, taking care of your clients, continuing to educate them, taking best practices to them. And, in terms of, building your own practice or helping to build a firm, keep your eye on the horizon. Do what's best long-term for your clients. And if you do that, everything else will take care of itself.
And that's really good advice. So basically pay attention to the long-term, not the short-term, and then also focus on those relationships because that's critical.
Absolutely.
No, makes
absolutely.
Sense. And then if you had, let's say, for a lot of people that are come into 2020 with COVID, all that fun stuff, there's been a huge amount of these individual traders coming into the market, and people with small amount of money, $5,000, $10,000, even $100,000. What advice, if you had to start over with $10,000, is there something that you would specifically do, or what can we tell these, people that are smaller or newer into the investing world as far as just some good things to do and things not to do?
Yeah, I think there's, there's folks now. I don't know how many folks are out there day trading single stock positions, or they have a 2 or 3 stock portfolio. I think longer term that could be dangerous to their financial health. And I wouldn't get too excited about short-term success. I mean, anyone who's bought Apple, Amazon, Netflix, the giant growth stocks, they've been phenomenally successful over the last 18
Right.
months, maybe 2 years.
Right.
But that can be deceiving. I wouldn't build a business model around that or a portfolio around that strategy. I would, even think about just diversifying more, perhaps using index funds, maybe sector specific, maybe more market oriented hedge funds, or excuse me, index funds.
ETFs
So
are,
be careful with concentrated portfolios.
that's really good
They
advice.
they work for very short periods of time, and when they work, they can be hugely successful. But it's a risky long-term strategy.
Yeah, it's a double-edged sword because when they don't work, they're not successful.
Right, right. Yeah, it comes back and really hurts.
Makes perfect sense. And then finally, Colin, what's the best piece of advice you can share with the audience, whether it's on Wall Street or just in life in general?
I'll stick to Wall Street. And again, I think in terms of building a business and a practice, and you want it to be sustainable.
Mhm.
And you do that by building trust with your clients, doing the right thing for your clients, and making sure that they fully understand the ramifications of what a portfolio can do for them, and frankly, what it can't do for them. It
Right.
doesn't solve all their issues, but it can solve a lot of them, at least along the financial lines. But again, I think it's all based on communication and long-term integrity in the business, and a commitment to the business, and being willing to change and adapt to an environment that's always changing, given technology, new products, changing markets. We're living through a very interesting time now, and we've had a
Right.
historic drawdown,
Yep.
and then we had a historic recovery.
In a
So
historic amount of time too.
yes, yes, in a
Right.
historically short period of time,
Right.
right? We had a really significant bear market and a very significant bull market all within 6 months.
Right.
So
Well, excellent.
there's never a dull moment.
Never a dull moment. Exactly. Well, Colin, thank you so much for coming on the show. It's been a pleasure. Hopefully we'll speak to you again soon.
Adam, thank you for your time. It was a pleasure.